for having me. Thanks to Jay and the crew for inviting me to present again. This is like my 6th or 7th time presenting here at the conference. It's fantastic. Like, unfortunately, market sentiment is what it is. We can't change it, so I'm actually quite excited to see a couple faces here. And you're still smiling. Must be early in the day. Market is open, so not everybody seems to be battered and hammered here. So quite excited to see some smiling faces as well. I titled my presentation "Don't Step into the Junior Mining Bear Trap: A Tale About Money," and I'll tell you a bit more about the title as we go through it, and why I came up with that, and why I think it is a bit of a bear trap that we're looking at right now. I got to be a little louder than Brent and JP Cortez over there, so I'll try to speak up maybe a little bit. Oh, there you go. And for those of you who don't know, what is Oreinc? Bought the company in 2016. We track all the financings in the junior mining sector, focused on TSX, TSXV, and CSE companies. We've locked over 35,000 deals so far in the sector over the last 10, 11 years now. And we're one of the few who really focuses just on junior mining companies. We have an in-house data analyst, and we're the only ones actually making use of the data as well. Our criteria, we don't track companies larger than $1.5 billion in market cap, and we don't track financings over $100 million. Also, we only focus on equity financings. We don't look at debt or streaming transactions. Really important because we want to keep the playing field level. So we can't look at when VRIC does a financing or Newmont issues another ESG bond. That's absolutely irrelevant to us because we're only focused on the small end of the market to see how healthy it is. When I said that we're the only ones using the data, I do mean it, because we're the only ones putting out the Oreinc index, or an index on the junior mining sector. And that makes us unique. We put this out every Monday. And it is weighted. It has 3 different factors going into the index score. It's total dollars of financings opened. Percentage of broker participation is an important one, and total number of deals opened as well. And as you can see, this is this week's index. It is quite grim out there. Ever since, I'll get into that actually, but it doesn't look great. Index score of only 26. It feels like we're back at 2015 levels again, based on our index scoring over the last few weeks. And as you can see, the purple background is sort of the 6-week moving average, or the 5-week moving average, sorry, and it's trending down as well. So it's not looking chipper out there. It's not looking too golden, and we'll see how much more of the storm we have to weather before things turn around. But the numbers speak a clear picture. Besides a few larger financings, ever since the first Fed rate hike, actually, like, the index sort of disappeared and financings in the juniors have collapsed. But more onto a positive note. Like, I set the scene with a very grim index, but it's not as bad as you might think and as it might seem. Unfortunately, I usually present this slide in January at each conference, but it's the total dollars raised for the year before and where we're at right now. So last year, if you can look at 2021, yeah, there's a laser apparently. But if you look at 2021, we've raised $6.8 billion in the junior mining sector. That's a phenomenal number, because we've only been beaten by 2011, where we raised $8 billion, and we all remember how frothy that market was in 2011. So considering how bad or how weak also the second half of the year was last year, $6.8 billion is a phenomenal result, and the money flew into the sector, like left, right, and center. We haven't seen a lot of market buying, but financings were extremely active. And looking at 2022 now real quick, so far and as of last Friday, we've raised $1.7 billion. Again, if you look at the numbers from 2015, 2013 in comparison, it's actually not that bad. Right? $1.7 billion, like in 2013, we raised $2.3 billion in total. In 2015, $2.4 billion in total. I'm going to make a fairly safe assumption that we're going to beat those numbers this year, despite how it feels right now. And even if you analyze the current number, we could be back at like $4 billion, maybe 2016 levels. And it's not that bad of a market on a financing front. I've mentioned banker and broker activity. That's a really important criteria that we track at Oreinc, because it tells us how healthy the market is, because you can make fees. Like, bankers make their fees, they get their 6% plus warrants and commission, and if they get active in this space, you will see more inflow of money, obviously. So far, 2021, we've actually been fantastic. 296 was the second highest again after 2011 in terms of brokered financings. Bought deals, 146 last last year. We're already at 102 brokered financings and 47 for this year, the 47 bought deals for this year. This is actually quite astonishing because the brokers are still here. They haven't disappeared. There's no other sector sort of taking away from the attention this year like we've seen before from crypto, weed. There's no competing sector this year. It's just overall market sentiment that is weighing down on the junior miners right now. And that is positive because we don't have to compete with somebody else. So if the money is ready to come back, it can flow into junior mining. One thing as well, we've only seen 9 bought deals since the first Fed rate hike on March 16th. So the financing activity is another sign that it's completely dried up. Bankers have slowed down, and those bought deals were almost like some of them were actually brought deals, meaning they already had a massive lead order. Arizona Sonoran comes to mind. They raised $35 million. $30 million was already subscribed for before they even announced the financing. So not that much of a challenge to add the extra $5 million to the deal. Total number of deals, also an interesting cross-cut as well. 21, we've actually seen less deals than even in 2020, but I'll get to that, what that means, the significance. But this year we're also on track for 424. We'll probably reach 2018, 2019 levels there again. So there is activity happening. Obviously, anytime before the March 16th, it was booming out there. Companies were raising money. And that's another sign of that as well. Why I highlight the average or the amount of deals is the average deal size. It's quite significant to take a look at it because you want to see where the money is flowing. And the average deal size last year was actually pretty much on par with 2011. Which is fantastic because it means it flows. It should generate value. That's what I mean by it's fantastic because it flows more into development plays, and we see it actually adding value. It goes into studies, it goes into resource updates, and or larger drill campaigns. And I've highlighted in the green box. I hope you can read it. It's pretty clear for me here on the screen down here. But in 2022, we've had 109 deals so far below $1 million, and that's roughly 26% of the overall financings were below $1 million. But if you look at 2021 or 2020, it's actually decreasing as part of it. So what does that mean? 2021 we had 36%. 2020 we had 44.5%, 45%, and it means that money is even flowing further to the later stage development companies. Grassroots is suffering. Grassroots companies, they're starving for cash just yet. But it'll come to that point if the market sentiment prevails, and they won't be able to finance over the summer potentially. Then we'll probably see that number jump up again, and the overall deal size will decrease, which I don't think is a positive sign, because if you look at 2013 and 2015, or even 2019 to a degree, we don't want to see those tiny financings, because they don't add any value. The only value they add is for PwC and all the auditors, because they can get to pay the bills, or for the venture exchange or the CSE, because the companies can pay for their fees to be listed and stay listed. It doesn't generate any value for shareholders, and it might put in some money into the G&A coffers to pay salaries, but that's pretty much it. And I don't want to return to that. So I'd hope we stay around that $4 million, maybe $3.5–4 million level for this year, and hope to generate some value out of that as well. Money flowing upstream, that's exactly what I just mentioned. Financings below $1 million is 26% this year, 40% below $2 million. So you can see that 60% of it are larger financings. As I said, it goes into production companies. Endeavor Silver, I think, is the top financing that we've tracked this year so far at, I think it was $56 million. That was the biggest financing in our universe. We didn't even get close to the $100 million threshold so far this year. As I said, Grassroots and Greenfield are absolutely suffering in that regard. I know of a couple projects that are trying to raise financing right now. They're still private. They've had their internal targets and they're just not meeting them. Flow-through is very interesting as well, because it's really, it shows also the political risk worldwide, and that's been changing. You're all aware the situation down in Peru, down in Chile as well. Not really the safest investment jurisdictions right now, especially for retail money or even if funds want to allocate. So where do you go? You go tier 1 jurisdictions, and Canada obviously is a tier 1 jurisdiction, and we do have the flow-through incentives, and you can see that in 2021, when the sort of turmoil in South America started and the regime change changes, like in Peru, that the money flew to northwards. It flew to Canada, and might as well get that nice flow-through premium and get the tax credits. Hence, flow-through it was almost 25% of financings last year, and it's already up to 28% this year. And I'm predicting it's going to be even higher towards the end of this year, based on certain budget changes on the federal level here in Canada as well. And it just shows people are not interested in political risk. Money back in 2019 or 2018 used to also flow more into projects like in Africa, more greenfields exploration. People were taking on more risk at the time. We're not seeing that right now. It's not happening. So I've bombard you with a ton of numbers. I have a lot more numbers, but I don't want to bore you. We can look at warrant ratios and premiums of financings, but that's not the point. I'm trying to explain my thesis why this is a bit of a bear trap, and I don't have a timing factor for you, but it feels like we're in a bit of a bear trap based on the money we've actually raised. Last year we raised $6.8 billion. This year we've already raised $1.7 billion. So there is money available for juniors actually to get their work done. The question is, who is doing the right work and who should you follow? That's up to you. I can't follow you that, but I think the market will turn around, sentiment will turn around based on actually history. I used this week's Oreinc index just to show where the Fed rate hikes happened, and those marked the low points sort of in the index as well. I've circled them in red. March 16th was the first rate hike, and then of course last week was the second rate hike. And I want to put that a bit in comparison. I hope this chart works out well and you can see it. I know the contrast is not the greatest over there with the projector, but on the bottom left side I put the GDX monthly chart, gold chart on the right, and of course the Fed interest, the federal fund rate at the top, and it really correlates nicely. And the only thing that we're fighting right now is a run for cash. People are there's a lot of uncertainty in the market. People are unsure what is happening next. We see mortgage rates increase. We see housing market decline. So people are fleeing into cash right now, and that's what we're seeing in the market. But gold is holding surprisingly well. It's holding up. We're still trading above $1,800 gold. It's not obviously $2,000. We're ways away from that. But if you look at the monthly chart, we're holding up nicely. And gold has put in a nice rally before even this all happened. And if you want to look at the parallels, that's why I drew the circles and sort of the arrows pointing at the events in history. It'll repeat itself. Like gold goes up during a raising interest interest rate environment, and that's what we're looking for as well. If you look at the GDXJ back in 2016, when the first rate hike happened, the GDXJ put in a rally, and same thing in March 2020. It put in a rally afterwards. So keep that in mind when looking at it. A couple things more on the exploration side where we're seeing in the junior mining space. I've taken the chart I've taken actually from our competitor, S&P, but it shows how the exploration spending obviously increased over the last 12, 18 months, and the overall budget worldwide, and that includes obviously the majors, was $11.2 billion that was spent on exploration last year. It's quite a significant number because it's up by 35%. Junior sector, and you could see we raised a record amount of money, increased their spending, fortunately, as well, and by 65% to $4.1 billion. But early stage exploration is at an all-time low. It's all flowing into development plays. And we see that all the top financings are later stage projects that are being financed that are attracting the big dollars. And that's just a fact. Ernst & Young put out a study more BC focused, but I think you can really extrapolate that and just say, well, that is worldwide. Late stage exploration accounted for 76% of total exploration. And you don't have to be a genius, but I'm expecting a slowdown in 2022, obviously, in that. But that has positives as well. Well, we still have lap delays. Drill availability is still an issue. So there's a silver lining in this. So keep that in mind. When companies or some juniors are not able to finance, there is a silver lining. Others will benefit. The ones with cash in the bank, those are the ones you should be looking at anyway. But they'll be able to get better drill crews again. It'll take a while. There will be a bit of a lag, but they'll have access to things they might not have had before or last year. So that is positive, and I'm looking forward to seeing that, because that the sector was held back, or our industry was held back massively last year by that. We're still I think one of the companies just reported their last batch of 2021 results. It's almost June, so that can prevail in the future, and that might help clean this up a little bit. Some of the sector trends and outlook, I hinted at it as well. There's going to be some budget changes in Canada on the flow-through program, and Canada is incentivizing investors with an extra 30% tax credit on critical metals. I still have to do quite a bit more reading up on what it means. I know it's been approved, but the law hasn't been written yet. So that's going to be something I'll be following closely, because I mentioned like 28% of the financing or the money raised so far was flow-through. I'm expecting that to jump up actually even a little more, and maybe some of the money like copper, nickel, lithium are definitely, or we already seen them at the top of the list for financings this year at Oreinc. So some of the top financings was actually a lithium financings. I think Rocktech Lithium raised over $50 million or around $50 million, and I'm sure we'll see more of those financings in the battery and base metal space in the coming months. And I keep bringing back this slide. I think I've been using this slide for the last 2 years, and so far I've been right on this. Lack in country and business model diversification is a big part of ESG. One thing we've been looking at, and I had another slide in here about mergers and acquisitions. Last year was extremely active, especially the second half in terms of transactions. Of course, because of market sentiment, nobody wants to pull the trigger on anything right now. So a lot of due diligence happening in the background, but no M&A activity just yet. But keep in mind, lack in country of business model diversification. There are quite a few projects out there, or companies that only have a single asset, a single producing asset. Torex Gold comes to mind in Guerrero, for example. Not the best jurisdiction. So if they really want to tick all the ESG check marks or boxes, they will have to diversify at some point. Otherwise, funds will say, well, we can't invest in you anymore when they tighten. And that's something I'm witnessing as well. I'm still waiting for it to really trickle down to junior mining, meaning how does it reflect in financings? Because I know investors are not willing to pay a premium for ESG. So how is that going to factor in? And you're not going to spend, when the stock is trading at 8 cents, you're not going to pay 12 cents just because of that, for example, just to account for that. But it's something to keep in mind, I think. It's been definitely at the forefront and something you shouldn't forget about. Other things I look forward to, or my outlook for 2022. We've seen Northern Star and Osisko Mining enter a joint venture. It has been dissolved since, but I'm expecting more of those joint ventures to happen, just to go in and support exploration. I just mentioned CSR and ESG of the previous slide. I think we'll see more of that happening. The Digby is gaining traction as well with their ESG certificate, something to look forward to as well. But it comes at a cost and time cost as well. And we'll see more diversification of producers. Like Yamana, for example, has been investing quite a bit into later stage development companies. Ascot comes to mind, like pre-production. I'm sure we'll see more of those. Agnico actually has been quite active as well, come to mind. And we'll see more of that happen. So diversification of the producers, building a bigger footprint in North America, and being a first mover. That's pretty much it. I hope it was insightful. If you have any questions, I'll be around. Thank you so much for joining, and thanks so much for attending.